Welcome to the deep dive. Have you ever stopped to think how an ancient religious duty, zakat, something we often just link with charity, might actually be shaping, big financial decisions,
It's fascinating, isn't it? It goes way beyond just giving.
affecting major investment funds, even your own personal investments?
Absolutely. It really does. And today we're diving deep into exactly that. Specifically, how Zakat works for different investment funds, stocks, sukuk, real estate funds, particularly in the Saudi market.
Right. And our mission here is to unpack some really surprising findings from a recent study.
Yeah, it looks at different scholarly views on calculating Zakat and the real-world effects these have. We're talking fund performance, how investors behave, even market efficiency overall.
It sounds complex, but think of this as, well, your shortcut to getting informed on something really crucial but often overlooked.
It is complex, but the ripple effect of Zakat is huge. This research really shines a light on how much it influences financial investment choices. It's not just about the real economy, like boosting spending or investment.
So it's not just, say, what car you buy, but it's actually guiding these bigger financial strategies.
Precisely. The study shows how Zakat impacts core investor decisions, like do you build your own private portfolio or go through an institutional fund? And it also nudges you between, say, quick trading, maybe even speculation, versus committing to longer-term value-building investments.
Makes sense.
So the researchers aim to estimate Zakat on these funds, looking at both the common ways and some alternative scholarly views, and then, crucially, seeing how these different opinions change the incentives for fund managers and for individual investors like you.
Okay, let's get into what sounds like the main debate here, because this is where it gets, well, really interesting financially. Two main schools of thought for zakat on funds, right? The first one, the dominant one, treats the fund unit itself as what?
As trading goods, basically, yes.
And how does that work out in terms of zakat?
It means a straightforward 2.5% Zakat each year on the whole market value of your units in the fund.
Simple enough.
Well, yes, but the assumption behind it is key. It assumes the fund manager is actively trading the assets, buying and selling, aiming for profit for everyone in the fund.
Okay.
But what's important about this prevailing view is that it often doesn't really look deeper. It doesn't differentiate based on your personal reason for investing or how much the manager actually trades or even what kind of assets the fund holds. It's kind of a broad brush.
Right. And the alternative view sounds like it adds more layers.
It definitely does. It argues that Zakat should be linked directly to the types of things the fund actually holds, the securities in the portfolio, and, importantly, how much the manager is actually trading.
Can you give an example?
Sure. Take an index fund. Its whole purpose is passive management, just tracking an index. Very little buying and selling.
Right, by design.
So that inherently challenges the trading goods assumption that the prevailing view makes. It doesn't quite fit,
And this isn't just theory, is it? What's the big surprise the study found about the real-world effects of these views?
It's actually quite significant. The study points out that the prevailing opinion, that simple 2.5% on the whole fund might unintentionally push people away from institutional funds.
Really? How?
Well, paradoxically, if you manage your own portfolio, you might be able to calculate your zakat based on the specific assets you hold, potentially resulting in less zakat overall.
Ah, I see. So it makes managing your own money look more attractive from a zakat perspective.
Exactly. Which could undermine institutional investment, the kind that often brings stability to markets and maybe even encourage more short-term speculative trading instead.
Wow. So zakat meant for good could accidentally add another cost layer, especially to active funds that might already be underperforming and maybe even slow down the growth of institutional investing. That's a ripple effect, all right.
It really is.
Okay, let's dig into specifics. How does zakat apply to different fund types, starting with stock funds? We mentioned the two views, trading goods versus looking at assets and activity.
Yes, the study covers those again for stock funds, but then we get to sukuk specialized funds and things get a bit murkier. There's surprisingly little dedicated research specifically on zakat for sukuk funds.
That seems like a gap. So what's the general idea for sukuk?
The general thinking is that zakat on sukuk is a lot like zakat on shares. It really depends on why the owner holds them and what the sukuk actually represents.
Okay, intention matters.
Right. If you're holding sukuk mainly to trade them, hoping to profit from price changes, then yeah, they're treated like trading goods. 2.5% zakat.
Standard.
But if you intend to hold them for the long term, for investment income, then zakat depends on the underlying structure of the sukuk.
Such as?
Well, for example, a participation sukuk, which is kind of like holding a share in a venture, might still be seen as trading goods. But an ijara sukuk, based on leasing an asset, might be considered mustagalat.
Mustagalat, like an income-generating property.
Exactly. Where zakat applies differently, often just on the income, and murabaha sukuk, which are more like debt instruments, are treated like debts for zakat. It's about the intent and the economic reality behind the sukuk.
And there's something interesting about government sukuk in Saudi Arabia.
Yes, there is. The Saudi Ministry of Finance actually covers the zakat for domestic government-issued sukuk and bonds.
Oh, yeah, okay.
And there was also an interesting case where the Al Balad Sukuk Fund tried to register itself to pay zakat directly, though it didn't ultimately happen. But it shows the incentive. If a fund pays zakat, investors can often deduct that from their personal zakat. Makes the fund more appealing.
Right. Okay, let's shift to real estate investment funds, REITs. These seem different, again, being about property and rental income.
Absolutely. And there's a long-running debate among scholars about zakat on income-generating properties, these mustaqalat.
So how does the study break down the views for REITs?
It outlines three main approaches applied. First, the Saudi Zakat Authority's method. This tends to align largely with treating the REIT units themselves as trading goods.
Huh. Even though the underlying assets are buildings.
That's one view, yes. The units are traded, so treat them like trading goods. The second view, held by most scholars, is different. It says if the REIT mainly holds properties just for rental income, like leasing out offices, then zakat is not due on the property value itself.
Well, only if they plan to sell the property.
Exactly. Zakat as trading goods would only apply if the REIT's business was buying properties to develop and sell.
Okay. And the third view?
That's one from some contemporary scholars. They suggest a 10% zakat, but only on the net rental income the REIT generates. They draw an analogy to zakat on agricultural crops.
10% on income. Interesting. So what does all this mean for you, the investor in REITs? Your zakat could vary a lot.
It really could, depending on the REIT type and which opinion is followed. A REIT that just holds stable rental properties might fit the mustaqalat idea zakat maybe just on income, or potentially none on the asset value under the majority view.
But a development REIT?
A development fund, one that's actively buying, building, and selling properties. That would almost certainly fall under the trading goods concept, meaning 2.5% on the value.
That variation is huge. And it leads perfectly into this really tricky issue the study mentions, double zakat, or authentifi as zakat. What exactly is that?
Double zakat basically means paying zakat on the same wealth more than once as it moves through different financial layers or companies.
And why is it such a big deal in finance today?
Well, modern finance is layered, isn't it? Wealth passes through multiple intermediaries. You might have a company investing in a fund, which invests in other funds, which then buy the actual assets.
Okay, I see the layer.
Each step, each intermediary could potentially trigger a zakat calculation under certain views. So you end up paying zakat multiple times on essentially the same pot of money.
That sounds like it could really mess up the market. What are the economic effects?
They're pretty negative, yeah. It distorts decisions. It essentially taxes the same wealth repeatedly, making institutional investment less attractive because returns get eaten away by these stacked zakat payments.
So it pushes people away from funds again.
It can, yes. And the worry is it might encourage individuals, maybe less experienced ones, to trade directly themselves, potentially leading to more market speculation and instability. It's a real headache for regulators trying to keep markets efficient.
Did the study mention any solutions, like this Al-Shibli proposal for stocks?
It did. Al-Shibli suggested a way to avoid double zakat on stocks. Basically, a trader would figure out how long they held the stock and deduct the zakat the company already paid on that share's underlying value during that period.
Sounds logical. Avoid paying twice.
The idea is solid, but the practical side, it's incredibly difficult. You'd need really detailed data like how much zakat did the company pay per share. That information often just isn't available or easy to track.
A data nightmare. Okay. What about funds investing in things that aren't normally subject to zakat, like foreign stocks from non-Muslim countries? How does that work?
Another complex spot. The Fiqh Council gives some guidance here. Ideally, the investor should try to estimate their share of any zakatable assets the fund holds, even if foreign, and pay zakat on that portion.
But if you can't get that info,
which is often the case, then the guidance is generally to treat the dividends you receive from that fund as income from mustahalat, like rental income, and pay zakat on that income stream instead.
So focus on the income received.
Right. But this is definitely an area where, technology or specialized services could really help in the future, making these calculations easier and more accurate.
Okay, let's unpack the next big piece here. Portfolio turnover rate, or PTR. This sounds like a way to objectively measure that trading activity we keep talking about.
It really is. PTR is a standard metric. It basically measures how much of a fund's portfolio is bought or sold over a year.
How's it calculated, roughly?
Usually, you take the total value of securities bought or sold, whichever is lower, and divide it by the fund's average assets. A higher PTR means more active trading.
And it's seen as important.
Definitely. The SEC in the U.S. actually requires funds to disclose their PTR. It tells you a lot about the fund's style and the costs involved.
But the study had trouble finding this number for Saudi funds.
That's right. It's not typically disclosed directly, so the researchers had to estimate it using clever workarounds.
Like what?
Two main ways. First, using the fund's reported dealing expenses. They know the standard transaction fee in Saudi Arabia is about 15.5 basis points. So by looking at the total dealing costs and making some educated guesses about discounts, they could estimate the value of assets traded.
Okay, working backwards from the cost.
Exactly. The second method involved looking at changes in the fund's top 10 investments over time. If the big holdings change a lot, it suggests more trading.
Got it. And once they had these PTR estimates, how did they link that back to zakat?
They proposed a pretty clear formula based on that trading goods idea. If the PTR is between 0 and 1, meaning turnover is less than or equal to the whole portfolio in a year, zakat is calculated as PTR times the portfolio value times 2.5%.
So proportional to the turnover.
Right. If PTR is greater than 1, meaning they turned over the whole portfolio more than once, then it's just a flat 2.5% on the entire portfolio value. Full trading goods zakat.
And if PTR is low or negative?
If PTR is negative, which can happen sometimes with how things are accounted for, especially with redemptions, it suggests the fund is holding for investment, not trading. So under this model, zakat on trading goods would be 0.
That's really interesting. Lower turnover could mean lower zakat? Did the two estimation methods give similar results?
Not always. The dealing expenses method generally gave higher PTR estimates than looking at just the top 10 holdings.
Why does that matter?
It matters a lot. It shows how much the assumptions matter and highlights, again, that we really need funds to disclose their actual trading activity directly. Without that transparency, calculating zakat based on turnover is still just an estimate and potentially not a perfectly fair one.
A crucial point. Okay, let's talk real-world impact. How does this PTR actually affect a fund's performance, its strategy, and ultimately whether investors like you want to put money into it? What's the link between PTR and performance?
It's complex, but often counterintuitive. You'd think more active trading would lead to better results, right? Seizing opportunities.
That's the pitch, usually.
But it also racks up higher costs, trading fees, taxes, and potentially higher zakat, as we've discussed.
Yeah.
And what many independent studies, like the SPVA reports, consistently show is that funds with high PTRs, these very active funds, often actually underperform simpler passive strategies over time.
So more churning doesn't necessarily mean more profit for the investor.
Often no. There seems to be a negative correlation, generally speaking. High turnover often leads to lower net returns after all costs are paid.
Fascinating. And what about the fund's investment horizon? How does PTR relate to that?
It's pretty direct. A high PTR signals a short-term focus from the fund manager. They're not holding things for long.
And that has wider effects.
It can. It might pressure the companies the fund invests in to focus on short-term results, like boosting dividends quickly, maybe at the expense of long-term investment, R&D, or sustainable growth.
Right, a focus on quarterly earnings over long-term value. And finally, investor attractiveness. How does zakat burden affect a fund's appeal?
It's fairly logical, really. Higher zakat liabilities, which, under the trading goods view, often come from higher PTR, mean lower after zakat returns for the investor.
Less money left over.
Exactly. So the study suggests, reasonably, that a fund's zakat burden directly impacts how attractive it is. Higher zakat makes it harder to attract new money, potentially limiting growth.
Okay, let's pull this together with the study's actual data findings. For Saudi stock funds, what did they see?
They looked at 32 funds for 2021. The big takeaway was the huge variation in the estimated PTRs from over 600% down to negative numbers.
Wow, that's a massive range.
It really is. And it just hammered home how much the results depend on the assumptions used in the calculation, things like broker discounts or how you account for new money coming in or leaving the fund. It makes getting a single precise number really tough without better disclosure.
And sukuk funds, what did they find there?
Unfortunately, not much in terms of applied data. They just couldn't find enough public information to do a similar analysis for sukuk funds.
So data gap there too.
A significant one, yes. It makes it hard for investors and scholars to really analyze the Zakat side for Saudi sukuk funds right now.
What about REITs? We talked about those 3 different scholarly opinions. How did that look in the numbers?
For the 17 Saudi REITs they studied from 2019-2020, the estimated Zakat amount changed dramatically depending on which of those 3 opinions you applied.
So the same REIT could have very different Zakat implications depending on the interpretation.
Precisely. It shows that the Zakat burden isn't fixed. It really depends on the specific jurisprudential view being used. That affects the REIT and, of course, you as the investor.
This raises a question listeners might have. Why weren't exchange-traded funds, ETFs, included in this study? The stock and sukuk ones.
Good question. ETFs were left out mainly because, for Zakat purposes, their underlying assets usually have Zakat dealt with already, further down the chain.
How so?
Well, for a Saudi stock ETF, the Zakat on the shares is typically paid by the Saudi companies themselves. For a government sukuk ETF, as we said, the government handles the Zakat.
Ah, so it avoids the double Zakat issue somewhat.
And also, ETFs are designed to be passive. They just track an index. They aren't actively trading to try and beat the market. That lack of active trading intent makes them distinct from actively managed funds when you're applying some of these Zakat rules, especially the trading goods concept.
That makes a lot of sense. So it really keeps coming back to this, doesn't it? The crucial need for funds to be more transparent, providing detailed info about their trading so Zakat can be calculated accurately and fairly.
Without a doubt. Better disclosure is probably the single biggest step needed. It helps investors, managers, regulators, everyone involved in making the market work fairly and efficiently.
What a journey. We've really covered a lot of ground.
Yeah.
You've just gotten a deep dive into the complexities of Zakat on investment funds
We've looked at the different scholarly views, the whole issue of double Zakat.
and the huge role of that portfolio turnover rate, not just for Zakat, but even for fund performance itself.
It really is a fascinating mix of religious principles, financial engineering, and market behavior. Understanding these connections is key in Islamic finance.
Absolutely. So thinking about everything we've discussed, how this ancient obligation shapes modern markets, where do we go from here? How might future changes in Zakat rules or maybe new financial technology reshape Islamic investing? What could that mean for your own investment strategy? What stands out to you?